You know that phone in your hand? The apps you use every single day? The websites you can't live without? Most of them probably wouldn't even exist without this powerful and kind of hidden force called venture capital. So what is this high-stakes world all about? And what are the hidden costs of its incredible success?
I mean, think about it. How does some wild idea, maybe scribbled on a napkin, turn into a global giant? A regular bank? No way. They're not going to touch it. It's just way too risky. So, where does the money come from? Well, more often than not, the answer is venture capital. Okay, let's get right into it. At its core, venture capital, or VC as you'll hear it called, is basically a high-stakes bet. You have professional investors who give a ton of cash to young, unproven companies. In return, they get a piece of the company, what's called an equity stake. And listen, they are not looking for safe, predictable returns. They are hunting for the next Google, the next Amazon, the absolute game changers. To really get VC, you have to understand the problem it was built to solve. And that problem is how to fund radical, world-changing ideas that traditional finance is just, frankly, too scared to touch.
And the scale of this engine, it is absolutely staggering. Just look at this. In a single decade, global VC investment just exploded from under $40 billion to over $250 billion. This isn't some niche corner of finance anymore. It is a primary driver of the entire global economy.
So how on earth do VCs manage this kind of extreme risk? I mean, they're not just throwing money around and hoping for the best. No, they have a very specific playbook, a set of rules for playing this high-stakes game.
For starters, their screening process is incredibly tough. VCs will see thousands of pitches, but they end up funding less than 1% of them. Think about that for a second. Even really good ideas get rejected constantly because they're hunting for a very specific kind of home run. And even when a VC does decide to invest, it is not a blank check. The money comes in stages or rounds. A startup might get some seed money to prove their concept. If they hit their goals, great. They can raise a Series A to find their market, then a Series B to scale up, and so on. But here's the catch. If they fail to perform at any stage, the funding just stops. It lets the VC cut their losses early and move on.
VCs also have ways to protect their cash. They buy something called preferred shares, which are not the same as the common shares the founders get. Think of it like a VIP ticket. If the company gets sold, the VCs get their money back first, before the founders or any of the employees see a single dime. And these shares often come with some serious power, like being able to block big decisions or even fire the founder.
But hey, when this model works, it really, really works. It can literally change the world. So let's take a look at the undeniable footprint this system has left on all of our lives.
Over the last decade or so, we saw this massive pivot. As things like cloud computing made it way cheaper and faster to start a company online, the money just flooded out of the really expensive sectors, like hardware and healthcare, and poured into software and internet services. This is the exact shift that gave us game changers like Airbnb and Uber. I mean, the results just speak for themselves. In 2019, 7 of the 10 most valuable companies on the entire planet started with venture capital. We're not just talking about big companies here. These are the very pillars of our modern digital world.
And get this, even though a teeny tiny fraction of startups actually get VC funding, they have this enormous outsized impact. About 60% of all US companies that went public in the last 2 decades were VC-backed. They just punch way, way above their weight class. But, and you knew there was a but coming, this incredible success story has a flip side. This model, which is so perfectly tuned for software, has some serious built-in blind spots. The same focus that makes it so powerful also means it leaves crucial areas of innovation behind, and sometimes it can create these dangerous market-distorting bubbles.
A big part of the problem is just simple timing. A typical VC fund has to return money to its investors in about 10 to 12 years. But a real scientific breakthrough, like a new drug or a new energy source, that can easily take 15, maybe 20 years to get from a lab into the market. The timelines, they just don't match up.
So, what you end up with is a system that's heavily biased towards web and app startups. Why? Well, because you can test the idea cheaply and find out super fast if people will actually pay for it. That makes it much less attractive for what's called deep tech. We're talking biotech, advanced materials, stuff where it might cost hundreds of millions of dollars just to find out if your science even works.
And this bias has led to what everyone calls the unicorn hunt, this obsession with finding startups that can hit $1 billion valuation. And you know what happens when too much money, driven by a fear of missing out, starts chasing too few of these deals? You get a bubble.
This unicorn hunt has some real dangers. Huge funding rounds for one company can basically starve all the smaller, innovative competitors of oxygen.
The goal stops being about building a profitable business and instead becomes about growth at any cost. We saw a perfect example of this in China, where enormous state-directed VC funds created this massive bubble that eventually collapsed in 2019, wiping out fortunes along the way.
So, if the private VC model has these limitations, who's supposed to fill the gap? Well, that brings us to our final section, the crucial and often pretty controversial role of governments in this whole innovation game.
You know, governments are actually essential for funding that early-stage, super high-risk, deep tech that VCs tend to avoid. By funding basic research, they de-risk these foundational technologies, like they did with semiconductors decades ago, and that creates the platforms that private VCs can then build businesses on top of. It's not about picking winning companies, it's about cultivating winning technologies.
But, and this is a big but, not all government help is created equal. Israel's Yozma program was hugely successful. It built a world-class tech hub by matching public money with private funds, and by bringing in foreign experts. Contrast that with China's top-down approach, which led to that bubble, or Saudi Arabia's massive investments abroad, which have done very little to build up its own startup scene at home. And this right here is the key. Israel's success wasn't just about handing out money. It was about actively importing the knowledge, the discipline, and the global networks of experienced venture capitalists. It was an investment in people as much as it was in capital.
So when you boil it all down, the crucial point is this. The venture capital model was a phenomenal tool for building the software and internet revolution. It is fast, it's disciplined, and it's ruthlessly effective. But the very things that made it so successful might just make it the wrong tool for building the next wave of innovation.
And that leaves us with a critical, and I mean really critical question. If today's venture capital machine is optimized for apps and websites, who is going to fund the hard, the slow, the expensive breakthroughs in science, in energy, and in new materials that are going to define all of our futures?